Welcome back. Now, inflation ticked up by 3.6% in December from 3.5% previously. And overall, average inflation for 2025 came in at 3.2%, the lowest in 21 years. In the meantime, consumer spending held up well in November, up 3.5% year-on-year in real terms from 3% in October. Now, what do these latest figures suggest about the local consumer? Koketso Mano, senior economist at FNB, joins us with her analysis. Koketso, thanks so much for your time today. Let's zoom in on the inflation figures first. That slight uptick expected, right? I mean, even looking at some of the forecasts from 2025, where many economists did expect inflation to tick higher in the second half of the year.
Yes, no surprises there. We did anticipate that, we would see this uplift in the second half. It's mainly a story around, these positive base effects that are leaving the data, that were expected to leave the data during that period. So the 3.6% for December, we also, called that one. So there were no surprises really in terms of those numbers. But I think one thing to mention about the 2025 number, you would see that it's 3.2% on average, down from 4.4% in 2024. And I guess it also really highlights for us as analysts the fact that we really did think inflation would not be that low, even with the fact that we expected an uptick in the second half, we were still getting downside surprises. So I think it speaks to the muted environment when it comes to inflation in South Africa.
While we are speaking about the muted environment in terms of inflation, an issue that remains unresolved, Goki, is the foot and mouth disease. And yes, we did see food inflation unchanged at 4.4%. But when you dig deeper into that report and you look at the inflation for meat prices, which was up about 12%. Any concerns when it comes to that? I do know that the Ministry of Agriculture has a plan in place, a vaccination plan in place to try and sort of curb that outbreak. But we are still feeling the pain at the tills, I guess, when it comes to the prices.
Definitely, I think meat prices will remain a concern, especially in the near term. When we speak to agricultural economists, they even say that, with the vaccinations, it'll still take time to really reduce the incidence of this, biosecurity issue. And also, when they do their estimates, they think that we may really think about foot and mouth disease being behind us in about 7 years.
Wow.
So it does not seem as though we will be able to resolve this issue very quickly. So we can think of meat inflation as an upside risk. But when you look at the numbers broadly, you will see that month on month, we only had 0.2% increase in broader food inflation. So it does also speak to the fact that you are still seeing compression when you look at fresh produce, for example. So that has been helpful to just mitigate some of the pressures that we're seeing in meat. And I think in general, what we think about the near term is that fresh produce will continue to show us, deceleration. We will also start to see some of that downside pressure coming in on cereals because, we're hearing in the markets, in the soft commodity markets, that cereal or wheat prices have really been lower compared to last year. So we're still waiting for that to filter through to the consumer price data. So I think food inflation in general, on average, in the near term could surprise us to the downside, but meat will definitely remain elevated.
All right, let's move over to the retail sales print coming in high at 3.5% year on year, of course, being boosted by Black Friday promotions. What I found interesting is that shopping around this time is starting to shift, right? Before, around Black Friday, you'd see consumers buying these big ticket items, your TVs, really big appliances. But what I noticed in that retail sales print is that the retailers that fared better were ones where you get your necessities, right? So your general dealers, your pharmacies, your medical goods. What does this say about the consumer and the consumer's health, where we are just prioritizing necessities at this moment?
Yeah, I think also when you look at the data over the past couple of months, not just the November print, you will see that there's been generally a broadening in spending patterns, right? Which is positive. I think it speaks to the fact that maybe more people can start to afford different items within their spending priorities, or even the discretionary spending. Because when you look at the credit data, for example, or even the new vehicle sales data, you will see that there's still a little bit of spending that's happening there as well. So I think there's a general broadening when we look at the broader consumer spending patterns. But you're so correct that for the consumers that are still experiencing financial pressure, that are still repairing their balance sheets, that are still feeling the pain of still restrictive monetary policy, you will generally see those prioritizing your more of your necessities, in terms of their spending. But I also do think going forward, what could be helpful for the consumer and maybe not so good for the SA manufacturers is that these cheaper imports that are coming in could help some consumers to afford, your more durable goods. As you said, your discretionary or big ticket items could also be more affordable for the general consumer, and that could support retail sales, but unfortunately, it might be at the cost of manufacturing.
Yeah. So what would you say where the SA consumer is? Are we still in recovery?
I would say we are, but that's when you look at the different segments, right? Okay. So let's paint the picture about coming out of COVID-19. So yes, we did have low interest rates. We did see, that uptick in spending, especially in your big ticket items, housing, the property market did well. Lower interest rates were really supportive. Then we go into 2022, 2023, when interest rates started to increase once again. And then they really lifted to around 8.25%. That really put pressure on a lot of consumers. For the consumer that bought property during that time when the policy rate was 3.5%, and now you're dealing with 8.25%, that's quite extensive. That's a lot of pressure for some of those consumers. That's why we still speak to balance sheet repair. For those consumers that are still in that position, you're still seeing a little bit of a recovery as interest rates have come down. But interest rates are still restrictive. So maybe when they move more neutral, then that consumer will be better able to participate a little bit more in the economy. But what you're seeing, which is something that we're seeing in the globe as well, is this K-shaped recovery, right? So your higher income of the high income segment of the household spectrum is the one that is starting to participate a little bit more. I guess what has been helpful here as well for them is the less policy uncertainty, right? So as you're getting a little bit more euphoria around South Africa, I think some of those consumers that have been sitting back a little bit concerned, yes, they do have the purchasing power, but still concerned around the trajectory of the country, are starting to play in a little bit more, and that's been helpful. So on broad, we think that, lower interest rates, lower inflation will start to support a lot more consumers going forward, while, this build-up of policy certainty, reforms will really support the high end as well.
All right, let's leave it there, Koki. Thank you so much for your time and sharing your insights with us today. Now, that was Koketso Mano, senior economist at FNB.